All right, so in this video, I'm gonna simplify the terminology as best I know how. What I'm gonna do here is I'm going to show you how to calculate the max VA veteran loan amount that you can take out, whether you've had a VA loan before or not. So the amount of loan that you can take out is proportional to your entitlement. I honestly hate talking about the term entitlement. I think it makes it more difficult to follow, and I wish we just talked about zero down loan amounts, what the max you can get as there. It would be easier for you to follow along. So I'm going to try and stay towards that lane, the zero down maxes, as easy as I can. And then talk about, down payments, how that affects this, and buying with non-spouses and house hopping at the end. When you're buying a home, there is a maximum zero down loan limit for VA loans in that county. We're going to use $800,000 as a max loan limit for zero down. Just for the purposes of this video, whatever county you buy in, that county has a max loan limit for zero down that you're buying in at that time. Now, if you previously bought in another county back in the past, that county's loan limit no longer matters to you. The only thing that does matter from that purchase is how much that loan amount was and how much entitlement you took out for it. But these county loan limits, they change every year. Okay, they usually go up over time with inflation, and the minimum max loan amount for one unit properties in all counties on these VA loans in 2025 is $806,500. Hence, this is why I'm using $800K for these example purposes. Just want to keep the math, a little simpler. And then the more expensive counties, they have loan limits that can be higher. They can go all the way up to, right now in 2025, the one unit properties, they can go up to $1,209,750. So that's for the big boys. That's for, your suburban New York City, San Francisco, DC, Boston, places like that. But just because it's more expensive in some suburban areas, doesn't even mean that some of these big hubs go past that $806,000 limit right now. So you can get zero down loans up to those limits, and then once you're over the limit, you've run out of your entitlement, or your guarantee is what the VA calls it, to get a loan. So now if you want a VA loan past the loan limit, you have to put down $1 of a down payment for every extra $4 of the sales price that you're past the limit on, that you keep on going up. So for example, let's say you already took out a $300,000 loan in a county with an $800K limit, and then you wanted to take out a new loan on another property that was $600,000. Well, $600,000 plus $300,000 is over the limit of that county at $800K by just $100K. So, up to $500K, they'd be fine. They could take out a zero down loan, but going up to $600K now, there's $100K that isn't covered by the VA entitlement and guarantee. So that buyer then has to bring $25,000 of a down payment in that instance. Remember, it's for every dollar past the loan limit, you got to take out a quarter, 25 cents for a down payment for every dollar past that limit. So $25,000 is proportional to the 100K over the limit there. And then if just another example, if you had no entitlement used, let's say, and then you wanted to buy a $1.1 million home in that same county where they had a loan limit of $800K, well then the first $800K of that $1.1 million purchase was covered, but the last remaining $300,000, that sale price needs $75,000, then would be needed for a down payment to cover that remaining $300,000 worth of sales price you wanted. Let's say you wanted to use then a down payment for one of many reasons. Let's say, lowering the payment, lowering the funding fee, whatever. Let's go back to our example where you haven't had a VA loan yet. And remember, the buyer was in that $800K limit county, wanted to do a $300K zero down loan, and then could still take out another loan for $500K. Well, let's revisit that. Okay, let's say the buyer wanted to use 5% down on his $300K purchase to reduce the funding fee. The loan would now be $285K instead of $300K. So he'd have used $71,250 worth of entitlement, which is simply a quarter of the $285K loan amount. Entitlement, that's what they use, that's this term. Instead of using $75K of entitlement with the $300K zero down loan, then could take out a loan of up to $515K with zero down before it got any bigger, and then wouldn't have to use a down payment. So this is an increase past the original scenario where he had only gotten a $500K max loan, zero down on his second purchase. So if you use a down payment or increase your down payment, it's going to free up more space for you for higher VA loan amounts in the future. Then there's a scenario of the house hopping, where you just want to buy a new house one after another, keep all those old ones, don't sell them off, just go from one to the next. You could, in theory, where there's a county that holds a $800K loan limit, have 8 different VA loans, all of $100K, open and being paid down, and you've got renters living in the ones that you don't live in anymore. You can literally just go from one to the next to the next to the next, open them out, and there's no rule against it. Now, paying off others, this restores your loan benefit. So if you were one of the hoppers and you bought 8 homes with $100K loans on them, then if you paid like 3 of them off, okay, or sold them or did something to close those loans out, then you would restore your entitlement to where you could then go out and take out another zero down loan of up to $300K somewhere else. It's called restoring your benefit. Also, if you refinance your VA loan into a non-VA loan, like a conventional or FHA or something else, that would then restore your benefit in that case as well. For whatever, that VA loan amount was that you closed out then. Then with refinancing, just from VA to VA, if you close out your original loan amount, open up a new one with a new VA loan that's big enough to cover the old loan, and maybe some other closing costs on top of that, your new VA balance on the new loan amount, the new refinance loan, that replaces the original loan balance you bought the home with to calculate then your remaining loan entitlement. One more wrinkle here then, the non-spouses, if you're going to be buying with a non-spouse, you can't do a zero down loan. With the proportional 25% thing, they see that, even if you're buying a house with a fiance, you can't do zero down. You would have to bring then 12.5% down to fit their needs and requirements. If you're about to get married, you can go to the county courthouse and sign a document, marriage certificate, early, so that you can then get the full benefit. But in that case, the conventional and FHA loans become more attractive if you're really looking for a product with a smaller down payment, and you have somebody buying with you that isn't doesn't have any VA eligibility. You guys easily might be ready to apply for a loan. If you think you would like to work with me, give me a call, text me. We can talk this stuff out, talk about your personal situation. I'm happy to go over anything with you. And I love working for the vets. You guys are so super respectful. And then also there's an awesome VA loan section on my playlist section. So there's a lot of more videos that are going to help you out with all the VA stuff. Highly recommend you go there, take some time, when you're mowing the lawn, walking the dog, on your way to work, you listen to these videos, and you catch on to a lot of more terms and understandings of concepts that you wouldn't have gotten elsewhere. So I'll see you guys on the next one, and thanks for watching.